Hi everyone, welcome to the latest edition of From the Desk. Just thought I'd check in at the moment because it's probably just a good opportunity just to talk about where we're at with the economy, the share markets and everything that's probably transpired since the last time we caught up, which was in the middle of June. So it does feel like in the last 2 weeks that the world has had a semblance of settling down. What we've seen, and I think a great example of that is even in the last 24 hours, where the US reported their inflation was at the highest point in, 50 years. The market didn't react. And if anything, we come out and Australia reports its lowest unemployment basically in decades, and again the market goes up. So if that had happened, 8 weeks ago, everyone would have been climbing the walls, talking about inflation, talking about interest rates going up, and the market would have been free falling like it was doing in June, where it was down, at times I think around 8 to 10%. So we've seen a change in sentiment to some degree with the markets, and I think that's really crucial when you see turning points that where the information you're hearing is seemingly quite negative and pointing in the direction of inflation and costs and goods going up, but the markets aren't necessarily reacting. The markets aren't reacting to that the way they were. So what have we seen? We've seen oil prices now, I think, are under $100 a barrel. That's down from 20 to 30%. It's down 20 to 30% from its highs. We've seen freight costs drop between 30 to 35% globally now, with freight traffic starting to ease up. The other one, even today, which was interesting, was that during the month of June, steel prices have collapsed 17% and are now down to where they were basically at the start of COVID. And so we're starting to see clear signs of some easing in cost pressures. Commodity prices are falling, like the price of copper is falling quite substantially. Fertilizer, urea prices are coming down. Consumer confidence is starting to cool off now. And all I probably see this is a bit of a snapback effect of where we had the pressure on the economy, where all the money went in certain directions, i.e. the housing market, and now we're having the pipe of opportunities where people can spend their money open back up again. And there's nothing more clearer about that than seeing our current airport systems and how quickly that snapped back. So all the domestic transport airports are back to 100%, and international seems to be bouncing back way faster than even I thought, which is, and I'm hearing and seeing signs of that everywhere at the moment. So how are all these things important? It means that interest rates are going to keep going up, and the RBA will keep their foot on the throat of inflation for a while. But as I've talked about, there's still this game of chicken. They don't want to cause a recession. And so it might go up. We're at 1.35% at the moment. I'm still expecting it to get to 1.75% perhaps, there or thereabouts. Even then, with the markets actually factoring in 2023, believe this or not, interest rates starting to come down again. And that's what the market's starting to look forward now for 2023. So you can see some light at the end of the tunnel of all this. 10-year bond yields, the US maxed out at about 3.6%. Australia was hit with 3.94%. Now they're both substantially down. I think the US is at 2.8%. Australia 10-year bonds are around 3%, and they have a significant impact on how share market pricing works. At the moment, the rhetoric out of the RBA and the Federal Reserve is that we're seeing a soft landing. I've attached some charts that I think everyone will find quite interesting. The first one we talk about is the returns that you get after a bear market. And you can see on that chart that on average, after a bear market with negative 20% return, which we've had in the last 6 months with the US, that the share market bounced back 11.71%. And the best, sometimes it's returned up to 22% in the very next year. So I think that was an interesting chart post World War II. The other one was around consumer sentiment that I've attached, is that every time the consumer sentiment has hit this point, since 1970, we've got the records back to there, is that the market's then rebounded quite substantially. And you can see there back in 1975, rebounded 22%, 1980, 20%, 2008 rebounded 22%, and in August 2011, it rebounded 15%. So I think that the where the market sentiment, consumer sentiment is at the moment is pointing towards a significant pullback in returns. The other chart that I've attached is just where US US debt is, government US total debt. And look, I'm not saying that I agree or disagree with where their debt levels are at, but you can see where the debt levels have moved through the 70s, 80s, and now. And I just think it points to a low interest rate environment for a very long period of time. And I'm not suggesting that interest rates should be 0.1%, but I'm also just really seriously don't think they can get back to 5 or 6% without causing very serious pain. Look, I think that at the moment we're seeing some weakness in the markets. As I said, we have seen that. I think the housing market now is starting to see some of that as well, particularly in the eastern seaboard, and some market commentators are calling that down anywhere up to 20 to 30%. Again, I don't personally see that. The Adelaide market's holding up very well, which is great. I think there's still a bit of money coming out of Melbourne and Sydney into our market, and I think it will continue to hold up pretty well. And so in short, I think there's some opportunities in this market. I think it's certainly no reason to panic about this market, and I think it's important to pick your way through it. And look for investment opportunities. It's always darkest before the dawn, and if you need any help, speak to us. But I think the next 6 months are going to be pretty interesting and hopefully much more positive than the last 6 months. Thanks for listening. Cheers.